Have you ever looked at the stablecoins just sitting in your account and thought, there's gotta be a better way to put this money to work? Something that earns a decent yield, but without the crazy risks of the open market. Well, that's the whole idea behind a new breed of financial products. Today, we're taking a guided tour of one of the newest ones on the block, Binance's yield product, RWUSD. So here's our game plan for this tour. First, we'll break down what RWUSD actually is. Then we'll cover how you can get started, how those rewards actually pile up, and of course, how you can cash out. After that, we'll get into the important stuff, the risks and other things to keep in mind. And finally, we'll see how it stacks up against other products on Binance. All right, let's dive in.
Okay, so first things first. Before we get into all the details, we have to answer the main question. What even is RWUSD?
So at its heart, RWUSD is what's called a principal protected yield product. Now that term principal protected is key. It means the initial amount you put in, your principal, is kept safe from market ups and downs. The yield, or the interest you earn, is generated from a mix of things, including Binance's own ecosystem, and this is the really interesting part, real-world assets, or RWAs. We're talking about things like U.S. Treasury bills. So you can kind of think of RWUSD as an internal receipt that tracks your initial deposit plus all the yield it's earning.
Now let's be super clear here, because understanding what this thing isn't is just as important. RWUSD is not a stablecoin like USDT or USDC. You can't go trade it on the market. It's not an on-chain token that you can withdraw to your own private wallet. And holding it doesn't mean you have a direct claim on some specific treasury bill in a vault somewhere. It's really just an internal IOU, a way for Binance to track your position within their system.
All right, enough with the theory. Let's get practical. How do you actually get your hands on some RWUSD and put it to work? The process is actually super straightforward. You just use the stablecoins you already have sitting in your spot account to subscribe. And when you do, you get RWUSD at a simple 1-to-1 ratio. So if you put in 100 stablecoins, you get exactly 100 RWUSD. Nice and easy. But here's a really important heads up. Which stablecoin you use depends on where you are in the world. For most global users, you're going to use USDT to subscribe. However, if you're an eligible user in the European Economic Area, the EEA, you'll need to use USDC instead. This is most likely because of regional regulations like MiCA, so it's a detail you definitely don't want to miss.
So you're subscribed. Now for the fun part, watching your assets grow. How does the yield actually get calculated and paid out? The headline number that's going to grab your attention is an APR of up to 4.2%. Now, hold on. Before you get too excited, this was a promotional rate for the first 30 days. The most important thing to remember here is that the APR is variable. It can and it will change with market conditions. It is absolutely not guaranteed.
The reward cycle is pretty simple to follow. Let's say today is day 1. You subscribe. Simple. Tomorrow, on day 2, your rewards start to accrue. Then, on day 3, the rewards you earned back on day 2 get paid out directly to your spot account. And from then on, that payout happens every single day. Okay, listen up, because this is a rule you absolutely have to understand. Binance takes snapshots of your balance multiple times a day. Your reward for any given day is calculated based on the lowest balance they record. So, what does that mean? It means if you add more funds in the middle of the day, you won't start earning rewards on that new amount until the next day. So you've been earning some yield. Awesome. Now, how do you cash out and get your original funds back into your hands? Let's talk about the redemption process. You've basically got 2 choices here, and it's that classic trade-off, speed versus cost. Think of it like buying a train ticket. You've got the standard redemption, which is the cheaper local train. It has a super small fee, just 0.05%, but it can take up to 3 business days to arrive. Then you have the fast redemption. That's your express train. It gets you there instantly, but it costs a bit more, double the fee at 0.1%. To make that fee totally clear, let's just use Binance's own example. Imagine there's a promotion where you get a 1,000 free quota on fast redemptions. If you want to redeem 3,000, that first 1,000 is totally fee-free. You only pay that 0.1% fee on the other 2,000. So 0.1% of 2,000 is just 2 USDC. You get 2,998 USDC back in your account instantly. Now, I know what you might be thinking. Wait a minute. Up to 3 business days? Isn't this crypto?
Isn't everything supposed to be instant? And yeah, that's a totally fair question. And the answer ties right back to those real-world assets we talked about. The yield is partly backed by things like U.S. Treasury bills. And when you want to sell those, you're operating on Wall Street's time, not crypto's time. That means regular banking hours and business days. That T+3 or 3-day settlement is a feature that's bleeding over from the traditional finance world. All right, this is a really important section, so let's focus here for a second. We need to talk about the fine print. What are the key risks and things you really have to consider before jumping in? This quote from the official terms and conditions really says it all. Your principal, that initial amount you invested, is protected from market swings. That's a huge selling point. But, and this is a big but, those redemption fees we just talked about can eat into your profits. So while your starting capital is safe, your total return could be less than you expect, especially if you redeem early, before you've earned enough yield to cover the fee. Now, here's a pretty cool use case, especially if you're a Binance VIP. You can actually use your RWUSD balance as collateral to take out a loan. And here's the best part. Even while it's being used as collateral, it keeps earning you those daily rewards. You're basically making your capital do 2 jobs at once, which is pretty powerful stuff. So after all that, you might be asking yourself, okay, this sounds interesting, but is RWUSD the right fit for me? The best way to figure that out is to see how it stacks up against some of the other yield products you might already be familiar with on Binance.
This comparison table is super helpful. You can see right away how different these products are. RWUSD gets its yield from a mix of operations and RWAs. BUSUSD, on the other hand, is all about futures funding fees. And then you have LDUSD from Simple Earn, which comes from crypto lending. The payouts are different too. RWUSD pays you out daily in more RWUSD, while LDUSD's value just quietly grows over time. And here's the kicker, the fees. RWUSD has those redemption fees, but something like LDUSD has no fees at all.
Okay, so let's boil this all down. If you're going to remember anything from this tour, remember these 5 things. 1. RWUSD is a principal-protected, flexible product. 2. It earns you daily rewards from real-world assets, like T-bills. 3. You can cash out for USDC with either a slow and cheap option or a fast and pricier one. 4, and this is a big one, it is not a tradable crypto asset. And 5, the APR is variable and is not guaranteed. And all of this leaves us with one big final question to chew on. As the crypto space hunts for more sustainable, more reliable, and less volatile ways to generate yield, products like this are popping up everywhere, bridging the gap to traditional finance. So the real question is, are we watching the beginning of a massive trend? Will tokenized real-world assets like government bonds become the new bedrock for stable and reliable yield in crypto? I guess only time will tell.